Tell me, you guys are known more as a value shop. There's been at least a move in your favor recently, although it's always unclear how long that's going to be sustained. What do you think?
Well, you can barely see it on the chart. It's certainly a market that's still reminiscent to us of 1999, 2000, where you have a subset of stocks that are doing extraordinarily well, and then a whole bunch of names, that are classically considered value doing quite poorly. If you look at the Russell 1000 Growth Index and the Russell 1000 Value Index, and you look back 10 years, if you look back at the past 90 10-year periods, value has only underperformed growth 9 times. 3 of them were in the Great Depression, 1 of them was before the tech bubble, and the 5 of them are the past 5 years. So it certainly has been a stressed period for value managers, but it's been a nice couple of months.
Yeah, well, I notice in your portfolio, though, obviously you do have names that have fairly low P multiples, but then you've got names that I certainly would not think of as value. For example, Netflix. How does that end up there?
Well, it ends up there because it's trading at a discount to what we think it's worth. Obviously, we're trying to assess, the present value of all the future cash flows of the business. Netflix today is not producing a lot of cash flow, but it's because they're putting a lot of investments into content that we think is going to generate quite a bit of future cash flow. And we think the service is essentially underpriced globally and underpenetrated internationally. And we think if you look out 5 or 10 years, it's going to have a significantly different cash flow profile than it does today.
When you talked about this losing streak on a relative basis that value has had versus growth been so pronounced recently, has it led you to reassess anything in terms of the types of things that you're looking for in a business, or how the market rewards different factors right now? Or do you think this is just, the pendulum's just stuck on one side at the moment?
I mean, we've seen this kind of thing before. I mean, in 2008, you could have paid $80 billion for Research in Motion, with $8 billion of revenue. And, of course, that was an impenetrable software franchise for business communications. And technology changed. And, I think you can buy it for $8 billion right now. We were debating in 1997 whether we should sell Eastman Kodak at $90 because Fuji had built a big factory in South Carolina to make film. We should have been debating, should we be selling it because their entire business is going away? Price is what you pay and value is what you get. And the job of our analyst is to figure out what these companies are going to look like over the next 5 to 10 years. Math will work eventually, and we're finding companies you can buy for 7, 10, 12 times cash flow that are amazing franchises, and we're happy to buy them, and we think that over time, as usual, that will work in our favor.
You have a couple of examples of ones that maybe more recently did surface based on those metrics?
Well, the pandemic, when it first hit, it certainly created a ton of volatility in the market. And, we took advantage of that to essentially buy names. We think that 3 to 5 years from now, people will be operating normally. And so, we bought names like Hilton. We bought names like Booking.com. CBRE, for example, is known as a leasing company. Actually, half of their earnings come from an outsourced property management business. Outsourcing it's early in penetration for that. It's only about 25% penetrated. CBRE and Jones Lang LaSalle are the big players there. Outsourcing companies in the market trade for 20-something times earnings, and you can buy CBRE for 13, 14 times what we consider its normal earnings to be today. It's a tremendous franchise. It was hurt enormously by the concern that people were going to work from home forever during the pandemic.
Shepard Smith here. Thanks for watching CNBC on YouTube.